SMB Investor with Nick Bryant and Sean Smith.
Hey everyone, you got Sean Smith here, Managing Partner of Search Fund Ventures and founder of SMB Investor Network. And today I'm joined by Robert Graham of SIG Partners. He's going to walk us through a handful of things about investing alongside SBA lenders, some diligence approaches, and just more generally how he's seen the ecosystem evolve and what that means for investors. So, Robert, thanks so much for joining us.
Thanks for having me, Sean. Excited to talk with you today.
Great. So why don't you give us kind of an overview of your background, how you got into the search space? I know you guys have, some pretty impressive deal metrics that you've pulled together over the years, and then a little more about how you work with self-funded searchers.
Sure. So I'll just start with the background, I guess. So I went to HBS and really learned about the self-funded search model there. I always wanted to own my own business, but learned about the model and then actually ended up going into private equity because I wanted to learn how to buy and sell companies. I did that for a little while and then decided to go out and do it on my own. And so I partnered up with a business partner and we did a self-funded search for about a year and acquired a small group of healthcare companies, which started Pillar Health Group. So Pillar Health Group, when we started, it was about $6 million of revenue. It was just, a typical self-funded search deal. We funded it with an SBA loan, but we started acquiring additional companies in the same industry, which it's home health, home care, and hospice. So in total, we've acquired at this point, I think we're on our 13th acquisition. We've also had incredible organic growth. So today, Pillar Health Group it's about 130 million of revenue, about 30 million of EBITDA, just a little south of 30 million of EBITDA. And almost half of that growth, just south of half of that has been organic growth, actually. So the other, call it a little over 50% has been through M&A, but we've been very happy with both the M&A and organic growth we've experienced over the last, call it 6 years. So that business is actually SIG Partners' largest portfolio company. I founded SIG Partners with two co-founders about 6 years ago with the goal of helping self-funded searchers find and acquire companies. And we've evolved a little bit in our model since then, but we've helped a lot of entrepreneurs, whether they're self-funded searchers, or others, CEOs and residents, or just entrepreneurs. We've helped people buy companies they were working at. We've helped them realize their dream of acquiring and running their own small business. And we're on our 32nd deal. So we just closed our 32nd deal a few weeks ago. So we've been doing it, and we're probably, I would guess, the longest tenured / maybe not longest tenured, because there have been some, individual investors who have been doing self-funded search for quite a while. But we're probably the highest volume in terms of equity dollars allocated into the space over the last, call it 6 years, I would guess, in existence. So we've seen a lot. We also published the first self-funded search study that was really ever created, kind of a complement to the Stanford study on traditional search. So there's a ton of good metrics in there. We did that a couple of years ago. But yeah, so we love the space and have enjoyed listening to your podcast as well, Sean. So I love that you've created something that's really investor focused, because I think that was something that was needed, and excited to talk with you today. So yeah.
Appreciate it. And what a tremendous outcome on, your guys' self-funded search and also your ability to support folks in the space. I think to your point, there's such a spectrum of qualified entrepreneurs out there. Many of them may not even, know that they have the option to take ownership of a business, right? Whether that's your mid-career executive in a PE-backed portfolio company or number 2 or 3 at a small business that has succession challenges. So it's great that you're supporting folks like that and others in kind of, making a life-changing move. You and I have talked a bit about some of the changes to the SBA program, and you guys are a great example of a group that got your start by leveraging SBA financing in order to build a business that started at $6 million in revenue and is now over $100 million in revenue. How do you see kind of the changing SBA environment either, benefiting or potentially hampering folks' ability to do that in the future?
Yeah, Sean, I wanted to talk about a particular development this morning that, is really kind of unfortunate, but it seems that the SBA is really taking kind of a very adversarial stance against professional investors in this space, whether that's funds or some of the individuals who invest in these entrepreneurs. So there's been several policies put in place recently that are not very friendly to those types of structures and investors, but I think the biggest one by far is a recent development that actually hasn't even been announced yet. But this new kind of policy by the SBA, particularly regarding their 7A program is basically anyone who's previously invested. It appears that anyone who's previously invested in a 7A deal that defaulted is now banned forever from investing in another SBA finance deal. So you could have put in $1, it appears, into a 7A finance deal 5 years ago. And if that loan defaults or defaulted, you'll never be able to invest in another SBA finance deal again. So that is a new policy that we've recently run into because we're constantly financing deals, and we've had a couple of lenders actually raise the flag that they were not able to move forward with us through the SBA's E-Trans system because we had an LP or two that had a default. And we, in researching that, figured out it was somebody who had invested in a deal years before, as a minority investor, and that deal defaulted. So it's a huge development that, is going to have huge repercussions for business owners who are trying to sell their business. It's going to have huge repercussions for searchers, entrepreneurs who are trying to buy these businesses. It's going to have repercussions, obviously, for the investors and the lenders. So everyone involved. My opinion, I think that it appears the SBA does not want professional investors or funds investing in 7A deals. And I think that position and this policy and that position, I think are very misguided. So happy to go into that if you'd like. But, I think when you think about what the SBA's mission is, right, the SBA's mission, and I was reading their website this morning to come prepared for this, but, I'll read this word for word. The SBA was created in 1953 as an independent agency of the federal government to aid, counsel, assist, and protect the interests of small business concerns, preserve free competitive enterprise, and maintain and strengthen the overall economy of our nation. So if you think about that being the mission of the SBA, right, how does forcing out professional investors or small funds, how does that help that mission? I think it accomplishes exactly the opposite. It's going to constrain the amount of quality investors and capital coming into this space. It's going to make it more difficult for the owners of these small businesses to transition ownership. It's going to make it much more difficult for entrepreneurs. I mean, imagine someone buying a plumbing company with, 2 million of EBITDA, and they're buying it for 8 times EBITDA, and they need to come up with $1 million of equity. They don't have that. This entrepreneur probably doesn't have that sitting in their bank account. They probably are going to need to find some investors. And if those investors are prevented from investing in those deals because they helped another entrepreneur 5 years ago by putting in a few dollars, it just doesn't make any sense. And I'll say that, the new kind of thing we're seeing develop in this space is the development of small funds, which, at the head of small funds, you've got a GP LP structure usually, and oftentimes the GPs and the LPs in those funds are highly sophisticated former small business owners. These are the people who should be backing these entrepreneurs. They bring expertise. Oftentimes they have additional capital. If the entrepreneur gets in financial difficulties, they can put in additional capital to help the entrepreneur. And they can provide the excellent advice, and they also are going to have capital enough to fund these larger deals that are requiring, $1, $2, $3 million equity checks. Without that, you're going to find business owners wanting to sell their companies and not having as many potential buyers because they won't be able to find the equity to do it. So the policy just doesn't make any sense to me, and I think it runs completely contrary, honestly, to the SBA's mission. I think it's extremely misguided. So, yeah, that's it in a nutshell, Sean.
Yeah, that's really interesting. And there's a handful of things to unpack there, but to start at the very beginning, you've suggested this policy hasn't yet been announced, but you guys, because you're doing so many deals, you're working with so many lenders and just across the spectrum of kind of, LP investors and searchers and all that stuff, you're seeing this feedback from SBA lenders, and it's kind of implying the fact that this may become more commonplace, or it already is commonplace behind the scenes, but it may actually be codified into an SOP change. Is that kind of what you believe may happen? Is that what you're suggesting? Or maybe it's just going to stay behind the scenes as a policy that SBA lenders adhere to?
Yeah, that's a good question. I don't know if it will ever become a public announcement or policy, or it will ever be put into an SOP. The fact of the matter is that the SBA, it's an agency of the U.S. government, and it operates under whatever rules, pretty much within certain constraints. It operates under its own rules, and this is clearly a rule that they've internally devised, and they're certainly enforcing it, because this is something we've run into at multiple lenders at this point and with multiple investors. So it's alive and well and happening. So whether it's in an SOP or not, it's reality.
Yeah. It's really interesting feedback, and as you've touched on, there's more funds that often have many LPs like ours in this space. What the implication here is that if any of those LPs had invested, to your point, $1 in a SBA financed deal, deal with SBA 7A financing, and that deal had defaulted, that whole fund would effectively not be able to invest in those deals anymore unless there, was an ability to exclude individual LPs for compliance purposes, which can be feasible. But again, to your point, it all comes back to the lender's interpretation. So even if we were to say, hey, we've excluded, and we looked at this very closely back when the SOP came out saying there's no, no foreign investors can own $1 or can own any percentage of a deal. So we looked very closely. Well, can we still bring investors that aren't U.S. citizens, aren't green card holders into the fund as long as we leverage our exclusion provisions? And the feedback from lenders was, I don't know. Right. And so we didn't want to risk going all the way to deal closing, about to wire funds, and then getting feedback that this deal is not going to, pass muster with the SOPs. And it's the same kind of feedback we're getting, you're getting with respect to this, call it non-default criteria. That's super interesting. Certainly going to create a barrier for folks. Go ahead.
Just think about this, John. You think about your model. How many deals have you guys invested in at this point out of your fund? It's a few, I'm sure.
Yeah, the fund has 6 deals. We did 4 deals before the fund, so you can call it 10. And I had mentioned to you, frankly, a minority of those have SBA 7A financing. But as we talked about, there's more and more lenders that are coming to fill that gap. And I wouldn't be surprised if it's precisely because of some of the dynamics you're talking about, right? Because it's getting harder to get those 7A loans. There's other partners. We've seen Grasshopper Bank appear on a few of these deals. There's more of these groups, and I expect it to continue that way.
I think you're probably right. You think about the implications of this new policy for folks like you. You've done 10 deals. You're ideally going to do many more. At some point, you will have a default, right? That is just statistics, right? Everyone does. Every lender is going to have a default. Every serial investor in this space at some point will have a default. I'm lucky that I haven't yet, but one day I probably will. And at that point, you as the GP won't be able to participate even in these deals, And so it's just, it's a matter of time. But everybody who's in SBA investing seriously at some point will be banned for life. That's just statistics. So it's interesting. I think that the points you made about alternative lenders is an interesting one. We've also seen SBA lenders pull back a lot on credit. I don't know if you've experienced the same thing, but the requirements, well, as you, I'm sure, are aware, SBA loan defaults are up, right? They've gone up over the last few months, and the requirements of lenders have gone up a lot. And things like, conventional debt that previously was, available by many lenders under 7A debt no longer is really available like it used to be. And so you've got these deals with, 2 million, 3 million of EBITDA for a really attractive purchase multiple that previously you would be able to finance with, some type of conventional debt underneath 7A debt. And then you'd have investor capital coming in. I don't know if that structure, in the future is going to be viable, unfortunately, because you've got lenders pulling away on the conventional financing piece, and then you've got the SBA investor issue that we just talked about. So it's going to be interesting to see who fills the gap.
Yeah, well, it's a real opportunity, and I think we talk about this a good bit on the podcast and just in other content. Frankly, the deals, at least for our thesis, this isn't true of all investors in the space, but I think for us, the deals that did kind of crank the turns of leverage all the way to 90% debt to capital and things of that nature were never really within our approach. And there's a few reasons for that. One of them is the whole step up mechanic that we've also talked about a good bit on this podcast and that would love to get your perspective on, Robert. But when you get a deal to that high of debt to capital and the investor terms aren't, I would say equivalent to what they should be in a typical LBO structure, is investors, equity investors own the full business and there's either a carrier or some kind of vested equity percentage to the operator or promoter, whatever you want to call it. But when when there's 90% debt to capital on a business, investors walk away with a 2x step up, owning kind of 20% of the business or something of that nature. There's a lot of financial risk investors are taking that you're just not really being compensated for. So that risk adjusted return calculation changes quite a bit. And I wonder if, part of what the SBA is clamping down on is these really highly levered deals, right? Where frankly, the largest beneficiary of that leverage, if things go well, ends up typically being the searcher. And that's especially true if the investors in those deals are friends and family who don't fully understand or appreciate the mechanics of the risk they're taking with that degree of leverage. So those are kind of the thoughts we often share, but curious to hear your thoughts on just those leverage mechanics, if that's a consideration here given the default rates and then the step-up structure, investor structures.
Well, this might be kind of an interesting conversation, Sean, because I think that there might be some a bit of a difference of opinion between us on some of these topics. For example, let's go through just a quick thought experiment here. So if you took a deal with a 2x debt service coverage ratio, okay? Two deals. They both have 2x debt service coverage ratio. One is 90% LTV and the other is 50% LTV. Which do you think is riskier?
I would agree with you that they both have a healthy credit profile because you want to look at the credit metrics themselves, not necessarily the debt to capital. But what we don't like is investing in the deal that has 90% and only getting the equivalent of if the deal had a 50% LTV. That's what a 2x step up implies. Yeah. So I fully agree with you. Debt to capital doesn't really matter. What matters are the credit metrics themselves. Frankly, it's fixed charge coverage ratio that matters the most, although that can be pretty tough to pin down, with a lot of these businesses.
I think fixed charge coverage ratio or debt service coverage ratio, whatever you want to call it, I mean, to me, that's the best metric of risk in this space. But
agreed.
You walked right into my little logic trap. Let's do our little experiment. Step 2. Okay, so we talked about these two businesses. One's 90% LTV, one's 50% LTV. You agree that the risk difference is minimal because they're both at 2x DSCR, right? Okay, so let's take those same two businesses and let me ask you, do you expect the same investor terms? These two businesses, everything else is the same except debt service coverage. Well, debt service coverage is the same. Only thing that's difference is LTV, right? 90% LTV versus 50. Do you expect the same investor terms for a 90% LTV as you do for a 50% LTV deal? Absolutely not. Right?
Well, we would like to get the same investor terms. We would like to own.
Well, I'd like all kinds of things, Sean. Is the expected return on a 90% LTV deal the same as it is for a 50% LTV deal with the same credit risk?
The expected return to equity is not the same.
No, it's much higher, right? How much higher is it?
Well, at 90% leverage, you're roughly getting a 10x. You should be getting a 10x step up on your money. In a sense, all things equal.
Let's just take step up out. Let's just take two similar deals. One's at 50% leverage, one's at 90% leverage. How much higher is the expected return on a 90% leverage deal than a 50% leverage deal, all other things being ignored?
All else being equal, it's 8 times higher.
Okay. So do you think that you should get the same step up or conversion of equity if the return is 8 times higher but the risk is the same?
Well, I would argue that the terms should be defined by what the sponsor, the searcher, is bringing to the table, right?
Well, here it sounds like an excellent deal with 90% LTV and extreme returns.
Now, there's something we're leaving out. The personal guarantee is certainly a factor, right?
That's another misconception. So do you think personal guarantee is the driver of these high, equity walkaways for these searchers?
Is it the driver? I would say the personal guarantee often has like a fee attached to it, but I wouldn't call it the sole driver. But if you think about like what separates an independent sponsor deal where the market says, hey, that person should get between 20% to 30% carry versus a self-funded search deal where the market says the self-funded searcher should own 80% of the business. I mean, what separates those two structures? There's a few things that come to mind for me, but I'm curious what you would say.
Right, there are a few things, and it's a very common misconception in this space that the personal guarantee is a significant driver of that difference. And I can tell you why it's not. So the main driver is leverage. Okay, so most independent sponsor deals are going to be at like a 50% LTV, somewhere between 40 and 60% LTV. Okay, just like the two deals we just described, right? In this thought experiment we're going through. Average self-fund search deal is going to be 80 to 90% LTV. So that means the expected returns are going to be so much higher. The PG, honestly, it's immaterial. And here's how I can tell you that. Because I've seen multiple self-funded search deals get funded with non-SBA debt requiring no PG, where either a conventional lender stepped up, some kind of a local conventional lender stepped up and gave that searcher a high LTV because it was a good deal and didn't require a PG. And guess what? The searcher got self-funded search terms. I've seen multiple deals get funded that way. I've also seen multiple self-funded searchers go get SBIC funds to give them high LTV deals. Didn't have the PG required, and they still got self-funded search terms. Okay, so the market would tell you that it's not about the PG, it's about the leverage. And this all goes back to this same mental model we're going through, where we're comparing this high LTV deal to this low LTV deal. When you have and with the same risk profile, credit risk profile, right? When you have so much of a higher expected return on the deal that's driven by this higher LTV, you can expect a much higher percent ownership for the searcher. Because realistically, you as an investor should be thinking about your returns based on risk, right? And the risk you really care about is debt service coverage. It's not LTV. LTV is not an important risk metric. It shouldn't be. It is for a lot of investors, but it shouldn't be. The important risk metric should be debt service coverage ratio. And similar, you need to think about the cushion you have over debt service. That's the right risk metric. So, but anyway, here's what I'm getting at. It's not the PG. That's a common misconception. The PG it's a small piece of it. It's all about leverage. And the market proves that out. I'll tell you also, I've seen multiple independent sponsors fund deals where they've gotten, it's an independent sponsor. They've had a high LTV and they've been able to get significantly over the 2 and 20 carry structure. And that's because they've delivered a deal at a low purchase multiple with a very attractive debt structure. And they're able to negotiate much better terms than, 2 and 20 structure. So I think the market proves that out.
It's a really interesting take. And I think there's a lot of truth to that. I would agree, right? If you bring a deal with a low multiple and high leverage to the table, that's certainly creating a lot of value for investors. I mean, that's not easy to put together, not easy to find, not easy to do all those pieces, right? However, I still want to double back to your thought experiment. So if you've got your 50% deal, 50% loan to value, and you've got your 90% loan to value deal, and you're getting a 2x step up on the 90% loan to value deal, but you're getting independent
conversion.
So you've got 20% ownership of the business.
Conversion, okay.
Conversion, right.
Yes.
You've got independent sponsor terms on the 50%, right? So there's a 20% carry, call it. It's just the lowest kind of textbook terms. There's probably some management pool in there, 5 to 10%.
Yeah.
You don't need to get to the exact calculation here, but which of those two do you prefer? Same debt service as an investor.
Would I prefer the 90% with 20% of the common, or the 20%?
The 80% effectively, 75%.
Yeah, or 80%. I mean, like, if I'm an investor, yeah, obviously I'm going to. Well, I mean, I'd have to look at the returns.
It's not an easy. Yeah.
I'd have to model it out. I mean, if I'm looking at this as an investor, right? But that gets to my whole point, though. That this is the next point I wanted to talk to you about is, this whole step up metric. It's not a good metric. It's something that's been injected into our space probably, 5 years ago.
Well, it's originally from the traditional search world, where it's truly a step up on the basis, right? That's kind of where, at least where I think a lot of folks first came into contact
I
with it.
think that it originally is from the world of venture capital, where you talk about the step up of the original investment, right, for future fundraises, which actually in the VC world, the term step up in that concept, it actually makes sense. In this world, as you know, let's think about the elements of what actually step up is. It's actually comparing the LTV of the company to the carry conversion, right? Or excuse me, the
Enterprise value.
common conversion, right? That metric on its face, honestly, it's absurd. I mean, so here's the problems with step up. Okay, so number one, it completely ignores debt service coverage, right? It just looks at LTV. Okay, so it also ignores purchase multiple. So we're going to say, hey, look, my threshold as an investor in this space is I want a 2x step up. So, but let's say you've got deal A and B, and deal B, has a 2x debt service coverage, and deal A has a 1.25 debt service coverage ratio. Okay, am I going to take the same step up for those two deals? No, the risk is way higher with this 1.25 times debt service coverage ratio deal than this 2x. Why would you take the same step up? Step up ignores risk completely, which is like the most important consideration when you're thinking about return, right? I mean, the number one thing you need to consider is risk, right? And these are all leverage buyouts. We're not even considering risk with this metric. It's such a bad metric. So, the other thing is it ignores your entry multiple. It ignores your future potential exit multiple. So let's say you're getting a great deal. So you're buying a SaaS company, in a great space for 3 times EBITDA. We're going to expect the same step up for that deal as we are for a 6x construction company, right? Just because, the LTV and the conversion makes sense. What about, the industry you're in, right? It completely ignores industry. It completely, ignores future growth prospects. It ignores the timing of cash flows, right? So like we talk about, the big thing between IRR and MOIC is the timing of cash flows. Like, do I want to think about MOIC? Do I want to think about IRR? The big thing is timing, right? Well, step up completely ignores timing, obviously. So the way to think about investing in this space is really a mix of IRR and MOIC. These are metrics that work for the entire rest of the investing world. And we've decided that we need a different metric for small business investing. We don't. It's a terrible metric. It leads people to make bad decisions on investments. I'll say that you need to think of IRR is the best metric, in my opinion, without a doubt. Okay. The problem with IRR, it doesn't consider the timing of cash flows, right? That's the number one issue. So it does consider the timing of cash flow, excuse me. But the problem is you can put too much weight on that in the space. So what we've found, after doing 32 deals, and I bet you've also thought about this, and you probably will experience this at some point. Many of these deals do not get held for 3 to 5 years. Many of these deals, the entrepreneur wants to hold them for 10, 15, 20 years, maybe even their whole life, right? And so, what happens when you're assuming a 5-year exit in your LBO model, and you're modeling out to that, your IRR is going to be inflated over what you're actually going to experience in terms of return, right? If you're assuming a 5-year exit and you end up having a 10-year exit, that's going to make a significant, apples to apples, that's going to make a significant difference in the IRR you're going to actually realize. Not so much MOIC, right? But IRR. And so, I should say it will make a big difference in MOIC.
If you're compounding effectively.
Compounding, right? So you really have to consider both metrics, right? Because if this business is not going to deliver in your modeling, if it's not going to deliver a solid MOIC, you really need to think about that. A lot of these models, I bet you've seen these from searchers, they show, they've got solid debt service coverage ratio, they're paying a low multiple, so they got a lot of excess cash flow over debt service. And they're showing all of that being returned to the investors in the first 2 or 3 years, right? Well, does that actually happen?
It can't anymore with the SBA SOPs, right? You got to pay down that SBA loan first.
Oh, no, you don't have to. I'm not aware of that.
Well, our interpretation and what we've heard from some lenders is before distributions can be made, any distributions can be made to investors, the SBA loan needs to be fully resolved.
That's not our understanding of the situation. Our understanding of the situation, in reading the new SOP and our counsel's interpretation as well, is that required payments cannot be, for example, in the operating agreement. commitment. You cannot have required payments to investors, but you can make discretionary distributions.
That's very interesting. And that's an important distinction because, going back to the conventional versus SBA conversation, a classic conventional term in, covenants that you'll see in conventional debt are restricted payments that virtually restrict,
Yes.
any payments to investors until the debt's paid down.
Yes.
Another unique element, back to the high leverage conversation, another unique element of putting together a great deal with an SBA preferred lender is that you actually can, or you could, distribute cash flows. Now, what I'm hearing you say, which is a really interesting distinction that I think we weren't aware of, is that you can distribute discretionary payments to investors, but you can't create non-discretionary, meaning required payments to investors.
That is our interpretation of the new.
And there's so many interpretations out there. So yeah. But that's a good one. And so, okay, sorry, I wanted to double down on that quickly. But so going back to your example, the model is going to often say, yeah, we're going to return capital in, 2 to 3 years. But the reality is not the case. Keep going.
I think that's very often the case. I'll be interesting to hear what you experience and think about that. Oftentimes, I think that, number one, searchers, there's a J-curve issue, right? And so oftentimes the first couple of years are not the best. And then the searcher gets their feet under them and figures out what they're doing.
Yeah.
And then you experience some of that growth so that, if you do experience a J-curve, you can pretty much take your IRR, your high IRR LBO model that shows all this cash coming back to you and toss that right in the trash, right? If you experience a J-curve. The other thing would be a lot of searchers want to build up, a cash cushion on the balance sheet, which I actually think is not always a bad idea. I think that's a good idea, is to build up some level of cash cushion. I think that's a very reasonable way to reduce risk. So what we're seeing, and then you have the hold period piece. So long story short, you have to consider these deals outside of just IRR. I think MOIC is a very important metric as well, but the two of them work together, right? And that's how it is in the professional large asset investing world as well, right? I mean, you consider multiple metrics, but I guess point I'm making here is that from our portfolio, we're seeing, I think, different hold periods and payouts than what you would see modeled in a lot of these deals.
Yeah. Yep. Super important call out.
Yeah.
We have spoken about this a few times. The J-curve point should be base case in pretty much every model, if not even included in any upside case you consider.
Yeah.
I mean, in virtually every scenario, margins are going to decline for the first 12 to 24 months. And that may be a good thing. That may be indicative of hiring qualified folks. It may be indicative of sales, investment, whatever you call it. It could also be indicative of just learning curve, right?
Not all growth investing is CapEx, right?
That's right.
I think
that's right.
That's a really good point. Yeah.
But to your point, J-curve means there's not going to be distributions. What it probably means is people are going to be on the edge of their seat hitting that debt service, right?
Yeah.
So that's just an important thing for anyone listening to this. If you're looking at deals where you're expecting return of capital in 2 years, it's probably pretty far-fetched.
I completely agree. Yeah.
So this has been great commentary, and there's one more thing I want to double down on that you said. When you're looking at terms for an investor, whether you're offered these terms by a self-funded searcher, independent sponsor, someone buying a small business that's raising minority capital, you got to consider the purchase multiple. You got to consider the credit metrics, the debt service coverage, the risk metrics related to LBOs. You consider loan to value insofar as it can amplify your returns. But keep in mind that step-ups are completely disconnected. Well, I shouldn't say completely disconnected. They're effectively disconnected from loan to value. They're disconnected from everything, but they're technically not disconnected from loan to value, because if I get a 2x step-up on a deal that has 80% loan to value, I own 40% of the business.
No, that is true. Let me cut in really quickly. But you know what does a great job of capturing LTV? So you don't have to rely on step up. You know what does a great job? IRR and MOIC. They both consider LTV. It's a huge driver. As a matter of fact, LTV is probably the biggest driver of IRR and MOIC. It's a huge driver.
Unless you're receiving ownership based on a step up, right? Technically speaking, because if I have a 2x step up on a 90% levered deal, my IRR is going to depend on the step up I'm receiving. It's not actually going to really consider the LTV.
No, that's very true. I just if you're going about it that way, sure. I think it's a metric that's kind of hijacked the entire space because now it's a bad metric, and now we've got searchers asking for terms based on step up, and we've got investors like deciding to invest in deals based on step up, and at the end of the day, really what it comes down to is think about this as just as you would any other investment, right? It's all about risk adjusted return. By the way, here's another thing. You've got most investors, they have like a set, in this space, they have a set step up. In other spaces, they've got a set IRR threshold for deals. So let me ask you a question. Should you have the same IRR expectation for, let's say you had business A and B. I love these A and B examples. Should you have the same IRR threshold for everything else the same, a business in the construction industry that's doing all new home builds versus, a business that's got recurring revenue in healthcare? Should you have the same IRR expectation for those two deals, all of the things being the same?
Yeah.
My argument would be certainly not, right? Because you have heavy industry risk in situation A, right? You have cyclicality, severe cyclicality in situation A, and very little of that in situation B, right? So I think my point that I'm getting at here is your return threshold should adjust based on the risk inherent in the deal. And that part of that is debt service coverage ratio. Part of that is the industry. Part of that is deal specific risk, right? So like, is this business a little bit seller dependent, right? If it's a little bit seller dependent, does my IRR expectation go up a little bit? I think that makes complete logical sense. And that's how we think about investing in this space, right? So we don't have like a, hey, if it's not a 30% IRR, we're not doing it. And if it's over 30% IRR, we're doing it. You have to consider all these things in context.
That's a great one. And that gets to the heart of one of the most challenging investment concepts, which is deciding what is your own cost of capital. What is your personal risk tolerance? And where do you, where does that change based on certain business dynamics? How do you attribute cost of capital to things like recurring revenue and, cyclicality, all that good stuff? I think that is a really good takeaway that we haven't talked about as much. And I mean, that's pervasive throughout finance, right? You don't get the same yield on an A-graded bond as you would on a C-graded bond. There's a reason it changes, and there's a reason that banks and credit firms have a different return that is required for those two assets. So that same principle and
applies within an asset class too. It's not just across asset classes, right? It's not just across bonds versus private equity. It's also true within an asset class. Wouldn't you agree?
That's right. Yeah, I completely agree. I think it's a great point. So, for folks listening, when you've got your high recurring revenue, purely preventative maintenance business versus your new install business, you got to look at those with a much different target return. And when someone asks you, what's your target return for this deal? Keep these concepts in mind.
Absolutely. Yep.
We've got 5 minutes left. I've been asking you to give some quick kind of hits on what are your top diligence items you look for when you see maybe it's trades or any business. When you see a business, take this example you just did, new install, recurring revenue. How do you get to a quick, sense of what your cost of capital should be or what the quality of the revenue is, whatever you want to share, but some quick heuristics for folks looking at businesses, because I know you guys look at so many of these.
I don't know if I have anything to say that's going to be particularly insightful, but I guess, when I think about trades businesses, this might be helpful. When I think about trades businesses, I really bucket revenue into three buckets. And you tell me if you have a different take on this, because I know you look at a lot of trades deals, Sean. But trades, building services, home services. I think about revenue in three buckets. One bucket would be pure service and maintenance. So this is like basically we're repairing a system that's already been installed, okay, in an existing home, okay? And then that's bucket one. And that to me is the most attractive bucket. Interestingly enough, it's usually the highest margin and also usually the least cyclical. So you got to love everything about it. The thing you don't love about it is the purchase multiple tends to be the highest, right? So people tend to know, in this space that, that revenue stream is the most valuable, right? In terms of dollar for dollar, right? So bucket two for me is going to be installations of new systems in an existing building. right? So like a replacement. Okay. So a good example would be in an HVAC company where replacing the HVAC system in an existing home that previously had an HVAC system. Okay. So installation revenue is attractive. It's not quite as attractive as bucket A. It tends to be more deferrable than bucket A. So this is another important thing. You've got discretionary versus non-discretionary demand. You also have deferrable versus non-deferrable demand, right? So replacing an HVAC system oftentimes, or replacing a roof, or replacing a garage door, oftentimes those things can be deferred for some period of time, right? And so in recessionary environments and things like that, you can defer purchasing a new one because you can patch the roof, you can put new Freon in the HVAC system, you can replace a part, things like that, right? So there's some deferral available there. You're also, when you can defer a purchase, you have more time to go get more quotes, right? You can go talk to a bunch of contractors and get the best price. And so that's pressure on margin. And you've also got the, hey, I don't have to buy it right now, so you can wait piece. So the third bucket, which is the least attractive in my mind, is when you're putting a new system in a new building, right? So that's new construction, quote unquote new construction, right? So that's going to be the most cyclical. And it tends to also be the lowest margin. And so what you find is that you've got contractors building these homes. These contractors have relationships with a bunch of HVAC companies, right? Oftentimes also, they're building a bunch of homes at once, right? They're doing a development, right? So they're going to build a whole neighborhood, in a suburb of Dallas, right? And so they're going to go get quotes from a bunch of HVAC companies on, installing HVAC systems in 100 homes. Well, that's going to drive down margin a lot, right? So it tends to be the lowest margin of the three buckets. It also tends to be the most cyclical of the three buckets because large projects like that, they tend to cycle, right? And so does construction of any kind. So not any kind, I should take that back, but most commercial and resi construction. So I think about home services, building services in those three buckets. What's interesting about it is HVAC, roofing, plumbing, garage door repair, landscaping. A lot of these services can actually be divided up in those three buckets. Interesting. How do you think about that? Is there any different take you'd have on my concept there?
No, I think those are the three buckets. And, we certainly see purchase multiples, varying quite a bit depending on those buckets. I would say the one thing that so we think about the spectrum of quality between those buckets, kind of back to your, I would say we think about the spectrum of quality. The middle one is the hardest to pin down, which is the new install or retrofit or replacement, whatever you want to call it, depending on the industry or the specific trade, in an existing building, right? Yes. And it's especially hard for like commercial, where these can either they could be smaller applications, they could be really large projects, so it gets harder to tell. I've told you a couple times I really like your metric, which is just look at the average project size. I think that's a really good starting point. But there's two more things we look really closely at, especially for that middle bucket, to get us comfortable and potentially move it closer in quality to the preventative maintenance. Not quite there, but that would be backlog. If there's a 12 to 24 month backlog, that's very underwritable, especially if it's contracted. Now you got to scrutinize the contracts, but that's attractive. If you've got retrofit replacement revenue, that's contracted backlog. That's one.
Yeah, I completely agree.
The second is work in progress, which is very similar in nature, but you've got these kind of two concepts, I would say, that can allow that middle bucket of revenue to move a lot more into the quality spectrum. Now, it can still be deferred. That's why you got to look at the contract. If it's something you can PO against, we have a business that has great contracts, but it's all got to be purchase ordered against. So it can still be deferred. That's not the same. But we've got another portfolio company that has great contracts in place where there's floors, right? There's floors that have to be paid. That's effectively recurring guaranteed amounts year over year, right? So these are dynamics. Those are just a few examples that can make that middle bucket of revenue a little bit higher quality. I wanted to ask you, though, how would you assign, and you don't have to have a perfect answer to this yet, how would you assign a cost of capital to each of those revenue buckets if you had to just do it off the cuff?
Wow. Yeah, so the kind of backdoor way I try to back into that is I would look at what the average multiple I was seeing in the market was for, ideally what these businesses were trading for, right? So if you had a fully pure comp that was service
Right.
versus a fully pure comp that was all install of in an existing building versus a construction, one. That's what I would do. And based on what multiples I was seeing, I think you could kind of back into approximately what the cost of capital difference is. I think it's significant. Don't you? I mean,
Absolutely.
you think about
this.
Yeah.
So the new construction stuff can often trade below 2 times, whereas the preventative maintenance stuff can trade 5 times or more. So if you created a target capital structure, based on all the search deals or all the small business deals you've seen and backed into an IRR based on that, I think it's a great approach. Classic sum of the parts sort of way to go about it.
So, I mean, just to your point, right? You've got construction at 2 to 3x probably, and then you've got, all repair, maintenance. I've seen them go, even small ones, 6, 7, 8 times.
Sure.
Even small ones. So we're talking about a cost of capital that's potentially even double. Wouldn't you agree?
Yeah.
Double.
That's probably about right.
Yeah, it's significant. They're totally different businesses, honestly. If you think, to me, there's no difference in an HVAC company that is installing all HVAC systems in new buildings. To me, there's almost no difference between that and a construction company in terms of the actual revenue attractiveness.
Yeah, and the exposure.
Yeah.
Very good. Well, this has been a great conversation. Thanks for all your insights. Anything you want to leave us with before we close out?
No, Sean, I love what you're doing with your fund. I love that you're bringing a new level of professionalism to this space. So all the power to you. And I love this podcast, by the way. It's great that we finally have something that really kind of speaks to the investor audience in this space because it's such an exciting place to be. So love what you're doing. Please keep it up.
Yep. Thanks so much, Robert.
Yep.